Hi guys. All right. Exciting day today. Exciting day today. I get to talk to you about your test and your assignment in the one day. Not funny? Not funny. Not funny. Okay, so some of you will have noticed that I put on the LMS on Friday some information about the test. 1 hour. The lecture time next week, it's on the main campus, okay, the main campus. Please have a look at the attachment on the LMS that I posted Friday. Seating's arranged, not like a normal exam, seating's arranged by your ID number. There's a list there. 30 multiple choice questions in 1 hour. Some of you, forgive me, you guys who have had my workshops today, because I'll repeat a little bit of it, not too much. Most of the questions will depend on your technique for multi-choice question answering. In other words, just read them carefully, take the full hour, that would be my suggestion. Take the full hour. The questions that we have provided you on Wiley Plus are a good general guide as to the sorts of questions you will receive, okay? Obviously, we're not going to ask you the same questions, unfortunately for you, I guess. We're not going to ask you exactly the same questions, but they are going to be indicative of the sort of material that you need. Some of you are going to, want to come and have a look at your test afterwards, and I'll put a date together, and you can come and review your paper. Almost invariably, the people that look at their tests, if history is any guide, the people that look at their tests will look immediately at the question and say, oh, okay, all right, fair enough. Didn't read the question, picked the wrong answer, didn't read it carefully enough, things like that. You guys are really bright master students. I don't want to kind of tell you stuff that you already know. So please, if you want to come and talk to me about how to prepare for the test, please do so. There won't be any practice tests available. The one reason being that with the cumulative Wiley Plus questions available for you so far, there's about 400 of them. All right, 400. So practice away. Go to your heart's content, okay? It's material up to and including tonight, but next week's workshops are completely irrelevant for the test, okay? So if you can absorb what's going on tonight, in tonight's lecture, do a little bit of follow-up reading, you will have any questions that are on the test relating to tonight's material, you will have them under control, okay? Tomorrow, I will put, you will have by about lunchtime, you'll have a document for your assignment. So the assignment, as promised, requires you to do a business case. We've provided some resources to support you in doing that. But a business case is essentially assembling qualitative and quantitative data to try and argue for a particular outcome. And the setting is the Australian Football League Grand Final. Now, some of you are probably sitting there thinking, I wouldn't know a Grand Final AFL from a can of potatoes. I don't know. They're different, right? But the actual setting is irrelevant. Or we're more looking about your ability to be able to do some research, talk about the process, isolate. The actual setting doesn't matter. Right? I could have picked it. A few semesters ago we did a similar project on a flower show, or a similar project on bringing an international band to Australia for a tour. So the actual process is what we're talking about. Anyway, sit tight. Tomorrow lunchtime. You've got about 4.5 weeks to do it. There's plenty of time, and it's 1,500 words. So I think if you put your mind to it in groups of 4, you could probably write 1,500 words in an afternoon. Now, I'm not suggesting you do it in the last afternoon before it's due, okay? But please get onto it early. Give some thought to it early. It is not a case of don't come near us. Please come and see me if you want to talk about it, but don't come and talk to me until you've thought a little bit about it. Because the first question I'm going to ask you is, yeah, great, happy to chat. What are you thinking so far? And I'll work with your ideas, okay? I'm not going to tell you, I don't understand. Can you talk to me about, no. Can you talk to me about what you're thinking? That's the kind of thing I'd like to draw out. The main reason for the focus on this business case is that if I had to identify one skill that I'd love for you to take away from the subject, regardless of your major, and that is to be able to put together a business case that, to argue for a particular investment or an initiative or a project. That is most likely the context in which you'll be using accounting information regardless of whichever career path you take. All right? It is one of the more commonly kind of required tasks the further you get up in an organisation. Anyway, so there are two housekeeping matters. All right? On to the business of the day. So I think what I've got today is a session that you will be able to relate to fairly closely, and that is understanding and managing cash and receivables. So just the setting, cash and receivables, regardless of a small business, medium-sized business or a large business, are one of the key sources of future sustainability. In other words, the more effectively you manage your cash and your receivables, the more likely it is you're able to continue in business, basically. I mean, you can earn all the profits you like, but it's when you've got enough, it's when you can generate enough cash from day-to-day operations to be able to pay the bills, pay your salaries, buy your stock, pay the power bill, etc., that really enables us to continue to operate. Okay? So, really crucial asset class. Okay. So, in terms of learning objectives, there are 9. No, there's not. I've missed 2 out. How about that? I looked at this and there's 7. All right? I'm just trying to trick you. So, in terms of the more important ones, they are these. I mean, they're all important, but if I had to identify what's really new today, okay, what's really new information, then I'd identify those 4. Identify the principles and applications of internal control in regards to cash handling. Now, last week we introduced some principles of internal control and the sort of general themes. I'll dive a little bit more deeply on that in today's session and talk specifically about how they relate to cash. And in doing so, I'll encourage you to think about some of the businesses that you deal with most often, because you'll more than likely see these internal controls play out. And the better you are able to identify them, and when effective internal control is most likely, equally the better you're able to identify situations where internal control is maybe deficient and certain problems can occur. So that's the goal of that conversation. Discuss the principles of cash management. I think you'll pretty much consider most of that to be relatively straightforward. But it's really one of the main kind of sources of new material is the apply methods used to account for receivables, including bad debts. So allowance for doubtful debts, bad and doubtful debts expense, etc. And the final one that I'll flag is explain the operation of a petty cash fund, because that's a really specific example of how internal control relates to a certain component of the cash balance. All right, so let's get into it. So we introduced internal control last week. So if I had to put a summary couple of lines, if I asked you what does internal control relate to, then probably 2 things: policies and procedures, right? Oh, it's freaking me out that this lecture theatre. It's a little bit creepy, right? Anyway, we're sharing a moment each week, right? So it's policies and procedures, but it's also the idea of making sure everything goes okay. All right. So it's... No, get it. We had a first year lecture a few years ago in the basement theatre, in the Copeland Theatre on the main campus, right? And I'd said, guys, try as best you can. As I've said to you guys, try as best you can to turn your phone off. This guy, like front and centre, he's sitting about where you are. His phone goes off, and there's 400 people in the theatre. I didn't have to say anything because it was a Dolly Parton song. Like, I don't know how many of you know Dolly Parton, but she's like a 60-year-old country and western singer. So in terms of embarrassing this guy or picking on him, I didn't need to pick on him because everyone in the whole theatre heard his ringtone. Right? You've got to be proud of your ringtone, right? Otherwise, because if it rings when you're in public and it's a bit embarrassing, then you cop it. So anyway, I digress. So internal control. So policies and procedures in place to make sure things run as they should. Right? A consequence is that assets are protected and policies are followed and accounting records are accurate. Now, right the way through so far, we've picked up information out of financial statements, we've made decisions on it, we've analysed, etc. An underlying assumption is that the information is believable. Okay? We haven't doubted the rigour of the information that we've used for the decisions. Otherwise, we wouldn't have made any decisions based on the information. A key reason why we've assumed that we can rely on the information is because of the strength of the internal controls. If internal controls are in place and they are operating well, the assets that we think we've got will be there. The profit we think we've earned, we will have earned. The expenses we think we've incurred will be appropriate. Okay? Policies will be followed, employees will be protected, assets will be protected, liabilities, assets and revenues, etc. will be accurately measured. Okay? A good internal control system is crucial for risk management, and in fact in the modern audit, auditors will spend a lot of time evaluating the internal control that's in place. Because if the internal control system is in place and the auditors have a higher level of comfort and confidence in the control systems that are in place, they'll do less testing. But if the internal control system has got some weaknesses, they'll do more testing because there's a higher level of risk involved. Okay? So, the question is, what are the themes, and this is a half recap and half kind of extension, okay? What are the themes of internal control that are consistent with strong internal controls? I mean, what sorts of things do you ideally want to see in place in a business? And then I'm going to step back from these and work out what's going to happen if they're not there. All right, so the first thing is you want clear lines of responsibility. You want only certain people being able to access certain assets. You want clear levels of expenditure. So, you know, I don't know how many of you guys have ever gone into the bank and you need a bank check. The chances are that the teller that you are dealing with will have authority to sign a bank check up to a certain level. Beyond that level, they need to get it reviewed and authorised. Okay, it's all good, but that's an example of the establishment of responsibility. You know what you're responsible for. Okay? Segregation of duties. Responsibility for certain activities assigned to different people. So you typically don't want someone recording the physical, responsible for the physical custody of an asset as well as the accounting for that asset. Has anyone heard of the Barings Bank? It's a UK merchant bank that went bust, about 10, 15 years ago. This is probably, up till the time of its collapse, it was the world's largest bank, world's largest merchant bank. There's one guy in the UK, one person, that was responsible for taking these positions on behalf of the bank in the trading market. And that same person was responsible for settling the deals, i.e. doing the accounting for it. That was put forward as one of the key reasons why this bank collapsed, that there was no segregation of duties, otherwise someone else might have seen the risk position that he was creating for the bank and they would have put a stop to it far earlier. As it was, he kept on trying to cover his tracks and trade out of his difficulty, and if any of you guys, some of you guys are fairly hotshot finance people in the room, he was probably only one or two deals away from, trading back into a kind of solvent position, but it didn't happen. The problem being that there was only one person involved and there was no sort of independent way of checking that he was doing the right thing. All right, so generally you want two people involved in a particular procedure to make sure that if something wrong's going to, provide a greater chance for someone to pick up an error, or, two people need to get together to collude to commit fraud, and it's more difficult. Okay? Documentation. Right, so documentation is really crucial. Most transactions for most businesses will be evidenced by documentation of some sort. Now, they could be an electronic receipt, they could be electronic purchase order, they could be a Email authorization is typically acceptable in a lot of instances, but documentation exists or clearly specified authorization by way of document for a start. Documents pre-numbered, right? So if you want to make sure that all of your receipts are intact and all of your check numbers are intact. Documents initialed, a common source of difficulty in a payment function, for example, is when you're actually paying something. You pay an invoice and you go to pay it and you don't initial it or cross it as being paid. You run the risk that you're going to accidentally pay it twice. Okay? Documentary evidence provides a clear audit trail for the auditors to come along later on and be able to go from the document right through to the number appearing in the accounting records. Physical controls. Right, safes and safety deposit boxes, locks, alarms, etc., etc., etc. Right, passwords to computer systems, time locks. You've seen them all, right, in the shops that you go to. More shops than ever before now are having have got those sensors just before the door. Now, I don't know. For all I know, they're hardly ever turned on. They may not be turned on, but they're there clearly as a deterrent for you taking something that's got a scanner and you're walking through and it goes off. Okay? Often it's something as simple as having a space between you and the teller, right? Or, the 7-Eleven stores, they've often got a grid or a screen between them so you slip the change underneath. Right? Most of the taxis in Sydney now, you get in the taxi and there's a plastic screen around the driver. Right? Bit odd, certainly you don't see them very much in Victoria. Right? Physical controls. All internal controls are trying to do is trying to make it more difficult for fraud or danger or something else to exist, to take place. And independent internal verification. Rotation of duties is a very, very common one. What's been found to be associated with errors or fraud in the past is where someone is reluctant to take leave. They keep doing the same thing. No one has any sort of look on, on what they're doing, any sort of review capability. Another set of eyes, review by an independent internal auditor, monitoring by supervisors, are all associated with high degree of accuracy or low degree of error and fraud. Right? So, wherever there's two sets of eyes looking over a particular function or a task or a duty, it's more likely to be consistent with good internal control. Okay? That's all okay, but the difficulty here is what I've sort of shown you are the principles consistent with good internal control. It's not always as easy as it sounds. Why? Well, all of these things are costly. If I go back here, for example, safety deposit boxes, locked cabinets, alarms, monitors, sensors. If you go and look for an alarm system for your business, for example, the most costly alarm systems are most likely to be very, very costly, and they might be continually physically monitored. So your alarm goes off and a security guard goes around in the next, within 10 minutes or 15 minutes or whatever. All good. But if you've got a small turnover business, highly competitive industry, you're watching your costs, less attractive. So costs and benefits is an issue. Some companies will address that by putting high fences up, high wire fences up, razor wire, big nasty dogs in the yard. Probably work for all intents and purposes, in a lot of occasions, probably work just as effectively. Right? Certainly, though, cost and benefits is something to consider. There's a human element. You can have all the policies in the world, but there's a human element. People get careless. People get tired. If you don't, you can make a mistake. You can know what you need to do, but no internal control system is foolproof. Collusion can get around it when 2 or 3 people get together to commit fraud. And carelessness, indifference, fatigue. Indifference means you don't care about the internal controls. Having a leader in your office that is committed to internal controls and shows good behaviour is absolutely crucial. Or alternatively, or put the other way, if you have a leader in the office that doesn't seem to pay any attention to internal controls, then that's really catching as well. And the size of the business. I mean, the size of the business goes to costs and benefits. But the smaller your business is, the less likely it is that you're going to spend more on internal controls. So I guess my message is, wherever you're working, or if you're designing a business operation, make sure that you undertake appropriate means to protect your assets and your people, and you make sure that things run as they should. And if you start off from that broad starting position, then you work out what do you have to do, what policies and procedures do you have to do to make it most likely that things will operate as they should most often. I mean, ideally, all the time, but you won't be able to guarantee it. Okay? But you see, next time you go into a business, have a bit of a look around. See what sorts of measures there are in some businesses to try and protect the assets. I mean, some of you guys drive cars, right? So when you go to petrol, particularly late at night, you'll see, you put the petrol in, you'll get the hose out for a start, and there'll be a couple of seconds delay. That means that there's an alarm going off inside the shop. Beep, beep, beep. Right, person presses a button. It has to eyeball you, press the button, so therefore they know that you're there. That's the first thing. Right, you start off, you look up while you're filling up your car, and there's cameras everywhere. Internal control. You hang it up, you go in. The shop is well lit. Cameras inside. They know where you're coming from. You can only approach one area. The distance between you and the person behind the desk will be quite far. I've never tried it, but if you're interested in reaching over, it's probably too far to reach over. Right? Don't try. There's typically a screen, right? So some sort of preventative kind of, bit of business that will stop you reaching in there. So all of these are designed to remove the incentive for someone to go in and rob them. They'll have signs up to say, there's no cash on the premises. Anyone seen them? Yeah? But if you walk in, you say, I've got $100 and I want a Chico roll, right? They'll go, yeah, sure, no worries. So, signs of obvious deterrence or obvious potential deterrence. No money kept on the premises. There is a time delay in the safe. So if you're interested in knocking over the safe, you're going to have to wait a while. Right? That is there to try and deter people from doing it. Okay? So there's different ways of approaching internal control. Even something as simple as you go to a market stall, right? A food stall at the market. You're more than likely you go to somewhere and you order some food and you get the food from someone and you pay someone else. Right? That's not necessarily an asset protection sort of thing, but if you're there to do one thing, then you're less likely to make errors than if you're having to go back and forward and do different things. That's just a simple example. You go to a business and you get a cash register receipt. You buy something, would you like your receipt? Yep, fine. We both agreed that I've just undertaken that transaction. Internal control. Okay. So please be aware, or please be able to, I guess, look at a scenario, look at a little case, and be able to apply and investigate whether or not, or think about whether or not separation of duties, authorisation, physical control, all of those things might apply to the little case study. Very askable kind of question. Almost as an aside, but worth mentioning, I guess, this idea of internal control has given rise to a completely new stream of accounting jobs in the field. Forensic accounting. There's a lot of forensic accountants out there, which sounds a little bit sinister, right? But when a company goes bankrupt, or when transactions occur that in hindsight maybe shouldn't have occurred, or when couples get divorced, or something happens in the family law court, typically what people have to do, what someone has to do, is backtrack or trace back all evidence of payments or receipts, or in other words, follow the trail of money backwards to make sure that people were paid, that were paid appropriately, or the money that was received appropriately. And this is part of the way that governments find out who's laundering money or who's transferring money across countries inappropriately, right? So this idea of the themes of internal control are consistent with this notion of forensic accounting. So, if you ever meet someone who says they're a forensic accountant, basically what they do is trace money trails to try and identify wrongdoings and address those wrongdoings. All right, so internal control. How does that relate to cash? So why are we thinking about cash, and how does internal control relate to that? So cash, most desirable asset because it's readily convertible, it's very transportable. And if you see cash in a balance sheet, it will commonly consist of a number of potential things: cheque accounts, cash at bank, online, bank overdraft, deposits, as well as short-term money market bills. So if you ever see the term cash and cash equivalents in a balance sheet, the reason is that it's defined as anything that's convertible to cash within 3 months. All right, that's the cash equivalent part. If you're unsure about how pervasive or how embedded cash is in a business, pretty much any, this is a diagram out of the text, right? So pretty much any operating, financing or investing transactions you can think of will involve cash at some stage. Whether or not it's receiving interest, whether or not it's paying tax, receiving cash from, well, dealing with customers. All right, so payments from debtors or cash sales. Bless you. Any more? No, okay. I once said bless you to someone and they went on and had 11 sneezes in a lecture in a row. I thought they were going to pop something. All right, they were okay in the end, in case you're wondering. Borrowing cash, sales of, whatever dimension of operation, whether or not there be operation, financing or investing activities, there will be some cash involved at some stage. Okay? Just provided some example, maybe a little bit, is that a little bit small? Is that okay? Yeah. Okay. Just provided some examples if you wanted to make an argument as to how each of those themes in internal control relate to cash, for example. So think about it this way. So internal control over cash receipts. How does that work? Well, establishment of responsibility. An example of that might be only having specific personnel able to enter cash in the records. Only one person does the banking, for example. And when they do the banking, you initial it so everybody knows who's done the banking. Okay? When you go to the bank, when the people start their day as a teller, they bring their cash drawer and they put it in. That is establishing your responsibility for that cash drawer. If you're the only one to touch that cash drawer, then any errors in it, it's you're responsible. You are responsible. Okay? As a manager, you go, well, that's what you need to know, because if there's 3 or 4 hands in the till, or 3 or 4 people operating out of the same cash drawer, it's difficult to know who's responsible for any errors. And then that reduces your ability to be able to manage effectively. Segregation of duties. Different individuals receive cash, record cash receipts and hold the cash. If you are the only one receiving cash and writing it in the accounts, then the chances are if you make an error or if you pocket the cash and don't record it, no one's going to know. So the takeaway from a situation like that is just to know when you are exposed. If you're running, and many small businesses, this is unavoidable. Right? So the way you would do that, the way you would cope in that respect is you just have weekly reviews, for example. Now, I've mentioned to you in the past that I'm an honorary board member of Multicultural Arts Victoria. Part of the role, and it gets to cash payments, right? But it's part of the job that I've got, unpaid job, honorary, right? Part of the job that I've got is to authorise the bank transfers each week, okay? So and it's very effective. What happens is the accountant will prepare them and he will lodge them with the bank. I get a notification to say that they're ready and waiting to be reviewed and authorised. I will do it remotely and another director does it remotely as well. Then every week or so, I will go to Multicultural Arts and I will spot check. I will go from the payments made back to the documents, all right, to make sure that they are all supported by documents. The other thing that commonly happens is that we have to sign cheques, right? So some people don't, they deal with a lot of contractors, and a lot of contractors actually don't have bank accounts, don't accept electronic transfers. So the accountant will bring a whole heap of cheques. I'll have a look at the blank cheque. It'll be filled out, but it won't be signed. The supporting documentation will be behind it. I'll have a read, all legitimate, I'll sign it. And then another person will sign it as well. So you've got documentation as supporting evidence. You've got separation of duties. In other words, the accountant who's actually entering it in the records isn't the one authorising it. And you've also got independent verification. So there's 3 different checks, as in 3 different control procedures, I should say. Independent verification, supervised account receipts, daily banking, banking clerk compares. So my daughter works at Muffin Break, right? You know, the muffin coffee place, fabulous. Anyway, that's beside the point. Of an evening, the boss will commonly come in and balance the till, all right? All the people that are working know that they know how to balance the till. But occasionally the boss comes in and just balances the till. Why is she doing that? She's absolutely doing that just to do a bit of a spot check on how things are going. I used to work at a hotel, and the boss there, you know, late at night, you'd be cleaning up and you'd find $50 under the table, right? And he would, and I quickly learnt this. He would be waiting for you to put it in the till and report it when you took the till up to the cash room at the end of the night. Oh, I found $50 at someone's. And he'll go, oh, sorry, I must have dropped that. What he's waiting for is to find out if someone, me or someone else, put it in their pocket and didn't report it. Okay? Another way of spot check, my wife has in the past been an independent shopper, a mystery shopper. She loves it. Anyway, they're employed by organisations to go in and pretend to be a shopper. Right, so you're actually an independent person coming in and buying stuff, which is her thing, right? And she writes a report on the staff, and she does that on behalf of the owners of the business. Independent verification, not internal, but independent sort of spot check. All right. So I dwelt on that a little bit just to give you an insight as to how you might make an argument as to why and how internal control relates to cash. All right? A specific instance of cash, of internal control, is a petty cash fund. Anyone? Well, no, I won't ask that. The petty cash is demonstrated in the appendix to the chapter, but I just want to show you a couple of things because this is internal control in action. Right, so petty cash is typically a small collection of cash, a little cash tin or a drawer that you might keep in an office to pay for little things like the paper or the milk or the biscuits for the tea room or coffee, tea, things like that. All right? So you establish the cash fund, and it might be more likely $200 or $300, and you might do it once a month. Or in this case, it might be once a week, doesn't matter. So you credit bank, you debit petty cash, okay? So the idea is to have some cash on hand if someone needs, oh, I need some stamps to post this, or I need some milk, right? Or I need some, if you work in an office and you run out of coffee, big troubles, right? So the idea is that at any time there should be $100 value in the petty cash. You take some money out, you write a little voucher, I've got $10, you bring back the change and the receipt. So you took $10, $5 worth of milk, put $5 back, $5 receipt. At the end of a particular month or whenever you need to balance it, it might be running low, you do a count up and there should be $100, $200 or $300 worth of cash plus receipts at any time. Okay? When you do that, then it's time to reconcile, or then it's time to kind of replenish the cash at bank, and you work out what you've actually spent the money on. So the assumption here is that we've done a bit of a count up, we've got $13 left. All right, we've got $13 left in the petty cash. We've spent $87, and we spent $44 on postage, on stamps, $38 on kitchen supplies or whatever, and $5 on other stuff, whatever it is. Okay, so those things end up being expenses. We enter them in the accounts. We've got to take $87 more out of the cash account and put it in petty cash to bring it back up to 100. Right? We store the documentation away, off we go again. Okay? So the petty cash is a really good, and have a bit of a read of it. There's not going to be, we're not going to dwell on it too far, but have a bit of a read because it's a really sort of small and contained example of the importance of sort of balancing up cash plus receipts to bring you up to the amount of the petty cash that the petty cash started. Another very common form of internal control relating to cash is a bank reconciliation. Now, a bank reconciliation is a form of independent check, and we do it for two reasons. One, what we're doing is we're doing a check of the correctness of our accounting records by comparing it or reconciling it to an independent record of our bank account, i.e. the information we get from the bank. It's possible the bank's made an error, but most likely, or the most likely use of a bank reconciliation is we're comparing what we think we've got in the bank to what the bank thinks we've got, and if there's understandable and identifiable reasons for there being a difference between the two. Now, there might be differences for two reasons. Essentially, the main one is that when you record something in your ledger account, you typically do it at a different time than the bank does it. For example, if you write a cheque, or let's say we're still writing hand cheques, okay? C-H-E-Q-U-E, cheque. You write a cheque. You go to make a payment. The minute you write the cheque, you credit your bank, okay? You put it in an envelope and you send it to someone. Old-fashioned way, maybe. The minute you write it, you credit your bank. But really, I'm going to send it to you. You're going to it's going to take a few days to get there. You're probably going to fluff around with it a little bit. You're going to take it to the bank, and it's going to take 4 or 5 days to clear. From the time that I wrote the cheque and credited my bank to the time when it clears my bank after you've put it in the bank, it could be 2 weeks, 3 weeks, a month, maybe longer. During that time, my ledger account will have been reduced, but the bank won't know that that cheque will be written, so the two will be different. Another example would be time between receipts that are recorded and when they're recorded by the bank. So if you record some money, you do a day's trade and you close late at night, a lot of businesses will deposit that money in a safety deposit box. Right? They might even do it weekly. They might have a safe on hand and then they go to the bank once a week. Okay? The moment or each day when the transactions occur, you will be debiting your bank ledger account, but the bank won't know that you've received that money until you take it to the bank, and if there's checks involved, the bank will clear it. Okay? Time lag is my point. The other potential is, that we have to adjust for is when you get your bank statement and you realise that some things have gone in or come out of the bank automatically without you knowing. Interest, charges, etc., etc. Okay. So the procedure. I'm going to show you what the procedure is. We're not going to do it. I'm going to show you what it looks like, then we move on. Okay? So I guess the, a key point there is if someone, and this is what I was referring to earlier, the reconciliation should be prepared by an employee who has no other responsibilities relating to cash. So in other words, this is what, if you've got a one-person office and you've got someone managing the office, the chances are that it's most beneficial if someone other than the person managing the office does the bank rec. That's the point. Okay? And you literally line up your bank statement and the payments you've made, and you tick the items that are recorded in both your bank statement and your accounts. You will get some unticked items. So there will be items in the bank statement that haven't been recorded in your accounts yet. You need to record them. There will be some items in your accounts that haven't been recorded in the bank statement yet. They're the ones you typically need to reconcile for. I'll show you what it looks like. Here's the example out of the text. Page 419 off the top of my head. So all I'm looking for you to do is follow it when I kind of explain it. All right? So if the bank statement says $312.40, okay? Now, we've got a deposit that we know we've received. We've debited our bank, but we just haven't taken it to the bank yet. Or it might be a whole bunch of cheques. We've just deposited $119.50 of cheques in our bank. They'll take 4 or 5 days to clear, therefore our bank doesn't know, hasn't registered the money in our account yet. So in terms of the bank statement ledger account, they've increased our ledger account, but not the bank. In order to reconcile the two, we add them to the bank statement balance. There is also a cheque that we've written. Cheque we've written number 1899 for $56, that when we wrote the cheque, we credited our bank statement. So it's come out of our ledger account. We credited our ledger account. It's come out of our ledger account, but the bank hasn't cleared it yet, so it hasn't affected the bank statement. In order to reconcile the two, we take it off. This is not an adjustment. This is a process whereby we're identifying legitimate reasons why the bank statement would differ to our ledger account at any particular time. And if we then reconcile back to our cash at bank account of $375.90 and it equals, we know that our recording is essentially the same or is accurate and in line with the bank's records. That's the purpose of the bank statement. And it also, the bank reconciliation, and it also provides things like this. So if we've got an unpresented cheque for this amount and it keeps on appearing in the bank statement, after 6 months, we can write it off. We can cancel the cheque. All right? And the only way you find out that you've got an unpresented cheque is if you look in your cheque, if you look in your bank statement for the month, you're looking for cheque number. It will say which cheques have been presented in your bank statement. And, you know, you've written all these cheques over here, you go through one by one, oh yeah, that's presented, that's presented, that's presented, and then the unticked ones will be the ones that aren't presented. So you essentially know that even though your bank statement says you've got $312.40, that's not really what money you'll end up having access to, because you know that there's more money that's about to be cleared, and you know that there's some money that you've essentially put aside for someone else because you've written a cheque and it just hasn't been put to the bank yet. So that's why when you get a cheque, and someone's paid you something, take it to the bank as quick as you can. Okay? All right, so what we might do is we might take 10 minutes. We might pause there and take 10 minutes. All right, so make it 6:05 now. Unstretch your legs. Off you go. See you in 10, okay? All right. All right. The idea is to give you long enough break to get a quick something, but not too much, so you make everyone else jealous. Right? So that's a little bit about the background, a little bit about internal control. What about now managing cash? How do we think about managing cash, particularly when it comes from receivables in the future? So we're sort of turning towards what are we going to do with this information first. So the main goal, or a main goal of a company regarding its cash, is to manage as most efficiently the operating cycle. So the operating cycle, and I've spoken to you about this last week a little bit, the time it takes from buying inventory and paying cash for buying that inventory or not, to when you receive cash from the customers to buy this inventory when it goes out the door in terms of a sale. So companies will commonly juggle a number of issues in and around this operating cycle. So when to buy inventory and how much to buy, and this comes up in this week's workshops. The more you buy, the more cash you've got tied up, the longer it takes to maybe generate cash in return, the more cost you incur for having to store the inventory. The more inventory you've got, the more crucial it is to generate a turnover as quick as possible, because every day that the inventory is sitting on the shelves, the money's not working for you. If that inventory, if you're a merchandiser, if you're a wholesaler and you're selling to retailers, then you sell it to someone, and then they might take a while to pay you. So from the time that you buy inventory to the time you receive cash from selling that inventory may be 20, 30, 40, 60, 90, 100 days. And when you're talking about 100 days, that's 100 days which you've got to finance your operations without cash. So, intuitively, and you guys are probably going to be all over this, intuitively you delay your payments as long as possible, and you get your receipts as quickly as possible. And ideally, if you can generate your receipts in order to enable you to pay your payables when they're due, that avoids you having to hold large amounts of cash on hand, right? Because interest rates are very low, and holding cash in at-call accounts at the moment is almost earning 0%. You're probably going backwards. So the smaller your balance of cash can reasonably be in an at-call account, the better you're likely to be. So, basic principles, and this is a relatively corny document out of the textbook, but it is a basis for you to start to sort of think these things through. Increase the speed of the collection of your receivables. Give organisations or customers a discount for early payment. When you're dealing with some companies that they're efficient in their debt collection because you take 1 day longer than the due date and you get another email or you get a bill and it changes colour. Right? You try delaying your phone. No, I'm not saying try delaying your phone bill. If you've ever delayed your phone bill, it'll change colour. Once it gets to red, you're only a couple of days away from having no phone bill, right? Or having the phone cut off, right? So my point is, where organisations got a large amount of their assets in receivables, it makes sense for them to spend more time collecting their receivables. So they'll have a well-established procedure. Right? Keep inventory low. Don't have any more than is necessary tied up in inventory. If you've got low inventory, though, you run the risk of not being able to satisfy demand when it occurs. And I don't know about you guys as customers, but if I ever go somewhere and I go to buy something and it's a competitive industry, and they haven't got the goods to satisfy my demand, you've got to put an order in. I'm going to go somewhere where they have got it, right? And if you go somewhere where they have got it and they satisfy your demand, you're going to keep going back there for the time being. So it's really crucial for organisations to have enough stock, have enough inventory to be able to satisfy demand, but not too much to mean that they've got too much stock tied up. Don't pay things earlier than you need to. I mean, really basic principle is that accounts payable is an interest-free form of finance. All right, so if you make a purchase on account, the chances are you won't get the bill until the end of the month. Then you might get another month or 45 days after that to pay. So you're kidding me? You've got 50-odd days to pay, sometimes 55-odd days to pay. It's like making that's when you pay for something on your credit card. Right? Depending on the time in the month cycle you pay, you get, at the end of that month you get a bill, and then you get the whole month, best part of another month in order to pay. If you don't pay, then you get stung a big interest bill. That's bad, okay? But there's no incentive, rationally there's no economic incentive to pay these bills earlier than when they're due. My mum always used to pay her Visa card bill the day she got it. Oh, are you kidding me? Anyway, doesn't matter. I don't like having bills. Yeah, I know. Okay. Once you get to know your cash cycle, when you're going to have more cash, when you're going to have less cash, you know when to plan your major expenditures. You know when you're going to be cashed up. You know when you're going to be cashed up and you can make your expenditures, and at the same time you know when you might have opportunities to be able to invest. Right? Invest in more stock, invest in capital expansion, invest in more people. Right? So once you get better at planning your cash management, you can take advantages of opportunities as they arise. Again, Fairly basic principles. Right. How do we calculate how effective we've been at managing our cash? Well, you'll commonly see a couple of different ratios, but one in particular is really simple and probably fairly transportable across different industries. And that is some form of cash need for your daily expenditures. Right? So whether it's a weekly or whether it's a daily or whether it's based on cash flow from operations, find a way, if you're responsible for cash management, find a way to work out how much cash on average you spend each month or each day or each week. And then you kind of work out how much cash you've got, and you run this kind of theoretical model to say, all right, if we shut down tomorrow, how much cash have we got to be able to survive day-to-day expenses? How much leeway have we got? 23 days, this might be Domino's, I think. Right? Yeah, Domino's. 23 days, not that long. Right? Not that long. However, we haven't got enough information to be able to explore further. Domino's, huge organisation, lots and lots of franchises, lots going on. So far be it from us to conclude anything significant at this point. But a lot of organisations, particularly smaller ones, will need something like this to be able to get some assurance, right? Arts organisations such as the one that I'm associated with, this is the one that we report to the board all the time. And that is, all these guys want to know they're really smart people but have no necessary accounting knowledge. Right? Give me some assurance or give me some comfort that we're going okay. The daily cash, cash to daily expenses or daily cash spend, they've got that much cash, it's ridiculous. Right? But it's transient, okay? They receive lots and lots of grants from the government, and then they've got to spend it. So it's really, there's averages and there's assumptions all over the place. However, the principle is that this will tell you something about how much cash you spend each day and how much theoretically you can cope if no more cash came in from here on. All right. So, what about receivables? All right. So, I mentioned the nice tight relationship between cash and receivables, and the receivables are a keen source of cash, as we saw that inventory is a keen source of cash last week. There's a bunch of different types of receivables that you'll see in a balance sheet. I want to really talk to you about one type. Here we go. Helps if I turn it on. I want to talk to you about one type, and that is accounts receivable. So we've been dealing with accounts receivable a little bit. Debit accounts receivable, credit revenue. All right. There's three things that I want to just explore with you in relation to accounts receivable. Three things across the subject. Now, I think we've done the recognising accounts receivable already. Okay? Valuing accounts receivable and accelerating cash receipts from accounts receivable. What about valuing accounts receivable? Okay. Why is that an issue? Well, it's an issue because there's value in the proposition for many organisations to offer credit. I'm not talking about credit card transactions. I'm talking about business-to-business credit, wholesale credit. I will sell you something, you agree to pay me in 45, 60 days, 90 days, whatever, or vice versa. Okay? Why would you offer credit? Well, you offer credit for a number of reasons. One, to increase sales. Greater convenience for customers, but the downside is you run the risk that people who make credit purchases may not pay. Okay? How do we cope when they may not pay? When we've got a debtor, and they go bad. We confirm that they're not going to pay us. We call that a bad debt. Right? So what do? There's two general options. Bearing in mind the objective of the balance sheet, as we've talked about in earlier weeks, everything contained in the balance sheet should, in the assets section of the balance sheet, should give you an understanding of the benefits existing for each asset line item. So if we say cash of $1,000, then that's a fairly good indicator that we have $1,000 in the bank. Or if it says accounts receivable of $500, then it's a fairly good indicator that we are comfortable that we expect $500 to be paid to us from our debtors in the future. Okay? The reality is that not all debtors will pay. All right? Not all of them will pay. Things happen. How do we cope? Well, there's two main methods. One, we wait until we get information that a particular debt is not going to pay us, and we write it off. So we debit bad debts expense and we credit accounts receivable. It reduces accounts receivable for the amount that's not going to pay. We recognise an expense. Done. Okay? Problem. What happens if they occur in different periods? So 2014, profit soars, we make huge sales, accounts receivable increase. 2015, profit plummets, interest rates rise, customer defaults, they're not going to pay. Problem being that if you've ever been in a business associated with a business where you've got a customer that doesn't pay, they don't ring you and say, oh, by the way, I'm not going to pay. Right? You'll send them a bill and it'll come back unpaid. You send them another bill, it changes colour, they still won't pay. You send them another one, changes, you ring them up, they don't answer, you drive past, and guess what? It's all boarded up. They're not paying, baby. Right? So, what do? Sue them. Yes, you do. Good call. Right? You ring up these big men in dark suits. No, you don't do that. That's bad. Right. The other alternative method is to use what we call the allowance method. It enables you to recognise receivables right throughout their life at their net realisable value. It involves two separate journal entries. First point, you estimate the amount of debts that you think will not pay you based on previous experience. Okay? Secondly, when a debt goes bad, you adjust the allowance, not the actual... you adjust the allowance and accounts receivable. I'll show you. So, based on our operations at the end, throughout the year, we estimate that $12,000 of our accounts receivable balance will not pay us. We don't know. We're going to estimate it. Debit bad debts expense straight into the income statement. Credit the allowance for doubtful debts. All right? Provision for doubtful debts, you might see it. Whatever you want to call it, allowance, provision, doesn't matter. Then you will see this listed in the balance sheet like this. The current assets, and all these figures are completely made up. Assuming the original balance of accounts receivable was $200,000, you'll see the allowance for doubtful debts of 12, and that gives you a written down value of 188 for accounts receivable. That is the amount that we expect to collect from accounts receivable. Okay? 188,000. It doesn't make any sense if we listed $200,000 in our accounts receivable in the balance sheet, and if we don't realistically expect to collect that much, then it's overstating our assets. Problem being, if we've got assets of current assets of $537, and we use that information to borrow against that, the valuation of our assets becomes absolutely crucial. Okay? So then, assuming one of those debts becomes bad, we verify that one of those debts is bad. Then, we debit the allowance and we credit accounts receivable. That's the point at which we adjust accounts receivable. Okay? So we're reducing the allowance because we're no longer thinking that a debt might be bad. We know that a debt has gone bad, but we've already provided for it. We've already debited expense and credited the allowance. Now we know they're not going to pay. They've skipped town. We know they've been seen in Guatemala sunning themselves on the beach, and we don't have any, it's too costly to sue them. So nice try, right? We're going to debit the allowance and credit accounts receivable, but look what happens. The realisable value of accounts receivable doesn't change. It's just the composition. The gross value of accounts receivable reduces, but the allowance reduces as well because it's no longer an estimate. It's now known that they're not going to pay. Okay? So essentially what we're doing is we're using the allowance as a valuation tool to get this figure right. So basically what companies will do is that they will review their accounts receivable balance and they'll estimate how much of that balance they expect to collect. The difference between what the balance is and how much they expect to collect is the allowance for doubtful debts, and that's the amount that they will raise is that entry there. So you use it as a valuation technique if you like. What I haven't talked about so far is how you arrive at that $12,000. It is a complete estimate. It is an absolute complete estimate. But there's two main ways that companies will derive that estimate. One, a percentage of net sales. So you might arrive at for every dollar of sale you make during the year, maybe half of 1% is will turn bad. So that's one option. Or two, companies will produce an aged listing of debtors. So you work out how much people owe you and what categories they're in. I'll show you. So here is an example, again, out of the text. This is what an aged debtors listing or an aged listing typically looks like. Okay? So here's all your debtors there. Then, based on previous experience and a little bit of sort of estimate, companies will, over time, get to know how much each category of debtors will likely fail. So think about it this way. So this not yet due, this tells you that this person has just transacted with us and we haven't sent them an invoice yet. So it's not yet due. All right? Of the $235,000, there's $58,500 that have been outstanding for less than 30 days or less. 46 and a half, 31 to 60 days, 33, 61 to 90, and there's $28,000 over 90. The idea being that the longer a debt has been outstanding, the less likely it is that they're going to pay. So you raise the amount slightly, whether it's 2, 4, 10, 20, 40, or different figures, completely irrelevant for this exercise here. The idea being, though, that when you start a business, this information won't be known to you, but you will get to know this information in due course. So, literally, 2% by 69 gives you 1,380, 4% by 58.5, 2,340, and off you go. That gives you a figure of 26,170 of what your provision should be. You work out what the balance is currently and you increase it to that amount. So let's say, for instance, if we were going from the previous number, there's the balance in the allowance for doubtful debts of 11,500. You work out based on your aged debtors listing that the balance should be 26,170. And you work out the difference between 11,500 and 26,170, and you increase the allowance for the difference. Okay? So what you're doing again, is you're using the allowance as a mechanism to value your accounts receivable balance. Okay. So a couple of things left to do. Then I want to talk to you a little bit about how to hunt out or how to figure out whether your receivables balance looks right, and then we're done. Okay? So reporting receivables, I think you're going to be fairly across that. Receivables typically will show up in the current assets section of a balance sheet. You might see receivables in the non-current assets section. They are by nature the ones that they don't expect to collect straight away or within the 12 months. You wouldn't typically calculate and include those in a receivables turnover ratio for obvious reasons. Okay? I want to talk to you a little bit about managing receivables. So we've talked about managing cash, but how does that map into managing receivables? All right. Some of this is fairly straightforward. So determine who to extend credit. Many businesses you will need to provide some sort of indication as to your credit worthiness before they start extending you credit. So if you're a tradesperson, it's probably a good setting. Probably not all that generalisable in the sense, but you know, if you go to a business and want to develop an account with them, that you will need proof that you can service that account. You'll need proof of your trading. Likewise, if someone comes to you, you need some sort of assurance that they're likely to be able to generate enough cash over time to be able to pay you. You need fairly clear information and fairly clear agreement as to the payment period. 45 days, 30 days, what happens if they don't pay straight away? What are your debt collection procedures? You need a very clear procedure, very clear benchmarks as to where you want to be about your key performance indicators. How do you know when you're managing your receivables properly? A typical couple of ratios for in relation to receivables are your average collection period or your debtors turnover, as well as your credit risk ratio. Now, there's a couple of things to note here. So your credit risk ratio, allowance for doubtful debts divided by accounts receivable. So you think about what's going on. So allowance for doubtful debts. So how much of your credit, how much of your debtors have you provided for that you think will go bad? All right. Now, 2012 Domino's 14.3%. 2013 12.6%. It's gone down. Right? That's good. But have a look at the calculation. Now, this is without implying anything about this company. It could be XYZ Limited. That figure there, up the top, is entirely at the behest of management. It's entirely a judgment by management. If you want to change your allowance for doubtful debts percentage, you can. Right? The only negotiation you've got to undertake is with the auditor, who will assess whether or not it's a reasonable calculation. Okay? 2%, 3%. It's very hard to stare. I've done it. Very hard to stare across the table, stare down an entrepreneur across the table who made their money for being, you know, energetic and charismatic and convincing and fabulous. Right? And you say, oh, it should be really 3%. They go, no, it should be 2%. Or it should be 1%. You go, right? It's really difficult because it's all forward-looking. Right? So I would be fairly cautious about something like this. Right? They've got accounts receivable of $5 million more dollars. I don't know what in thousands. Yeah, it's $5 million more dollars, and they've only allowed for $200,000 extra in allowance. That could mean that the additional debts are really good debts, or it could mean they've changed their policy. Now, what I'm going to tell you about in a minute is beware of any time when someone changes their policies about something. Just as a general point, that's all. Okay? A more generalisable ratio is this one, and that is accounts receivable turnover. So net credit sales divided by average receivables. Typically, you won't have net credit sales, so typically this will be net sales. And obviously, net sales are going to be more than net credit sales, so this will be larger. Yeah, sorry, your turnover will look better than what it really is because you're picking up the numerator, which is a bigger figure, larger figure. All right. So what does this tell you? It tells you, on average, how many times you turn over or you make your receivables will pay you. Now, if you think about this, 5.67 times for Coca-Cola Amatil. So divide that into 365 and you get about 65 days. I don't know. Someone do it if you can do it. 5.67. It's less than 6 times a year, so it's going to be about 2 and a bit months. Yeah. All right. Now that lines up, doesn't it? So if someone has got a bill, right, we deal with a customer, they're going to probably get a bill at the end of the month, and then they're probably going to get another month to pay. So it's going to be about 60 or so days. That kind of seems about right to me. Okay? The quicker your receivables are paying you, the quicker you get cash, the more that you can transact and do other stuff. You divide that in, oh, there you go, 64. I didn't make that up. I forgot that I had that. Anyway. You divide that into 365, that means on average your debtors will take about 64 days to pay you. You know, if this company, and it's gone out from 2012 to 2013, which is not a good result, but, you know, I think it's safe to say that Coca-Cola Amatil aren't going anywhere anytime soon. But what you need to do, like for a lot of companies, reducing, if they've got a substantial debtors figure, reducing that by half a day or a day a year can be a substantial windfall of cash for them. One day, half a day, or 1 day a year, right? Can be significant. All right. Let's finish off with two things, a discussion about two things. One, a little bit more about how to manage receivables by way of accelerating cash receipts, and then talk about how to sniff out or how to, at what point do receivables and receivables management not look right. All right, and then we're done. So, how do companies maximise their cash receipts from their receivables? Well, some of them will sell their receivables or factor their receivables, F-A-C-T-O-R, factorisation. You might go to a bank or a big investment house and say, I've got $1 million in debtors here. Why don't you collect them? I'll sell them to you. So the company might sell them for, I don't know, $950,000, for example. So we're basically factoring out, we get $950,000 cash, boom. They take that, they go collect the cash, away they go. So they've essentially charged us $50,000 to take on the risk of collecting our debtors. Okay? Quite a common situation. Why would you do that? Oop, I'll drop you coming apart. It depends on the size of the debt. Right? Reduces the cost of invoicing and collection if you need an injection of cash straight away, minimise the risk. I don't think I'm going to collect it all. I make a judgment as to whether, you know, am I going to miss out on $50,000? Probably about. I might collect it all, I might not. Therefore, 50 grand's probably a good price to pay to get $1 million in to get 950 grand in straight away. That's the kind of trade-off you need to make. All right? Factoring or sale of receivables. The other thing to consider that a lot of companies will consider is making credit card sales. Now, credit card sales are effectively cash, right? Situation being that a credit card company will charge you. Anyone ever been into a shop and you flash out your card and they'll say, oh, there's an extra 1% surcharge or 0.5% or whatever it is? Now, that to me, I find that really annoying. I don't know about you. But that's a mode of business that they have chosen to undertake. To me, that's a cost of doing business. It's their cost, not mine. Anyway, that's beside the point. I finished the sermon. I didn't mean to offend you if you've got a business and you charge the surcharge. What are we doing? So we make a sale, and I should have put figures on it, right? But if we make a sale, we generate revenue. 10% of that we add on GST payable. We debit receivables, and we also debit a credit card management fee. So there's an actual fee there. So there's the 1% or whatever it is. There's the 1% charge there. Most credit card companies like banks, etc., will deposit money in our account if we make a credit card sale by the end of the day or the end of the week. So it's essentially the same as cash. Because when you pay your credit card, right, you don't pay the local milk bar or the coffee shop or whatever, you pay the bank. So businesses are essentially paying money to the bank to compensate them as a sort of a fee for transferring the risk of collection to the bank. So if you default on your Visa card, it's the bank's problem, it's not the individual vendor's problem. Okay? In exchange for which, of course, the banks charge the businesses a fee. So as a business owner, you've got to weigh up the likely surcharge or the likely credit card merchant fee that you're going to pay with the potential to increase your sales as a result of being able to offer credit card sales. Right? So there's only one or two. So Myer, I think, have a Myer card. Do they still? Someone help me out, maybe? Up until recently, Harvey Norman had a store credit card as well. I'm looking at the shoppers. There's some ladies, particularly, and some men going, yeah, they do. Yeah, I use it all the time. Mine's worn out, right? But a lot of the big retailers also will not have them and will use bank cards or Diners Club or Amex or Visa cards, MasterCards, things like that. Where they've got their own store card, they retain the risk of non-payment. Where they use an established another institution, they are transferring the risk of non-payment. All right. So, but that is overwhelmingly, not only do businesses choose to offer credit card sales as a means of convenience, but also as a means of ensuring that they're essentially like cash anyway. All right. So what else? What else? In keeping with, I don't know if this is resonating. I've chatted to a few of you who kind of like these little anecdotes at the end every now and then. Cash and receivables is a good one as well to share a few anecdotes as to when you look at some information, how do you figure out whether it makes sense? Right? How do you figure out whether it makes sense? In evaluating a company's performance, particularly in the presence of credit sales, it's difficult to know how to go about it. Companies report and want to report as good a behaviour as they can, particularly where there's judgment involved. That means making debtors' balances look better than they are, being a little bit reluctant to revalue them downwards. In other words, very few businesses are going to voluntarily over-provide for the allowance for doubtful debts. In other words, never ever as an auditor did I ever have to go into a business and say, your allowance for doubtful debts is too high. Right? The conversation was almost always whether it's too low or about right. Okay? So what sorts of things would I look for? What sorts of things would I encourage you to look for? It's not about, right? So companies growing quickly, alarm bells, ding, ding, ding. If you grow quickly, are the structures in place to cope with that growth? I'm going to show you after next week, I'm going to start showing you a couple of videos here and there that deal with a company, a fairly famous company in Australia, a few years ago now, but which collapsed. But the problems of internal control were really significant. Grew really fast. Watch out for things like sales growing way faster than profit, which we've already talked about. Receivables growing way faster than revenue, or growing way faster than revenue. Now, this comes up in workshops this week, not necessarily with receivables, but certainly with stock and maybe receivables. All right? If you are making sales and you're increasing and you're recognising an increasing portion of those sales as receivables, you run the risk of not being able to collect them. Okay? So any time that sales or receivables are growing faster than revenue, at a faster rate than revenue. Any instance, and this is more when you're within a firm, any instances where there's some doubt about the finality or the completion of the sales cycle. Everyone knows Sunbeam? They used to, they make mixers and white goods in the kitchen, things like that. 1997, they were forced to reverse $30 million of sales. $30 million of sales. Because they recognised Sunbeam are a really good earnings management case study. If any of you guys are looking for allegedly dodgy practices, right? Have a look at, just Google Sunbeam, accounting scandals Sunbeam, all right? But what they did was that they had at least, and this is documented fact, they had at least $30 million where they recorded sales, right? So I'm selling goods to you guys, but we've agreed that I'm giving you long time to pay, and I'm going to hold them. So you go, yeah, fine. Right? So you don't have to pay for a long time, but I'm going to hold the goods. So the real risk here that there's actually a sale having taken place, because I've still got ownership, I've still got responsibility, I'm holding the goods, but I'm recognising a sale. Doesn't sit right. Right? $30 million. Sales that the buyer can reject. Exceptionally long payment time. Wherever a company changes its procedure for providing or raising an allowance. So this is the one down here. Whenever a company changes its provision policy, we're not going to provide for 5% of all credit sales. Now we're going to provide for 4%. Really? Turning accounts receivable into notes receivable. Symbol Technology, 2001, reclassified tens and tens of millions of dollars of accounts receivable into notes. They wrote to their debtors and said, we'd like to convert it. We'd like to convert your debt into a note receivable. Now, why would you do that? Why you do that is so when someone calculates an accounts receivable turnover, all those debts all of a sudden disappear from the calculation. Are you kidding me? It's really simple stuff, right? These are all documented earnings management techniques that companies have used over the years. So it goes to the point, whenever companies reclassify something or change a way of calculating something or things are growing at a really fast rate, you need to do more analysis. That's if you start off with those sorts of rules or those sorts of mindsets when you're doing analysis, you won't go too far wrong. A quote, what you need to do though is you need to understand the accounting, and that's what we're doing here. Here's a quote. I don't know technology and engineering. I don't know accounting. Anyone know who said that? There's a prize. I'm only kidding about the... Well, the prize is you get to go as soon as we figure out who it is. All right? I'm going to tell you. Anyone know who? Well, Bernie Ebbers was the co-founder and CEO of WorldCom. Up until recently, WorldCom was the largest company collapse in history. CEO and co-founder. He claimed to not know about... Bless you. He claimed to not know about the what accounting numbers and what the performance really was at WorldCom, the company that he was CEO of. For those of you who are interested in how old Bernie's going these days, he's now serving 25 years jail in a jail in Louisiana in the US. Very high profile fraud, okay, going on at WorldCom, brought down one of the larger Big Four accounting firms that used to be a Big Six accounting, right? Brought one of them right down, collapsed, Arthur Andersen, okay, really famous. I don't know engineering, I don't know technology, I don't know accounting. Get to know your accounting, then your analysis skills will go through the roof. They will grow exponentially. Anyway, see you next week. Guys, those in the workshop for tonight,